Hello everyone, and welcome to this section. In this episode, we will explore the fundamental concepts and principles of accounting. Whether you are a student, a small business owner, or someone curious about how accounting works, you are in the right place. By the end of this video, you will have a solid understanding of the basic rules that guide accounting practices worldwide. Let's dive in.
Welcome to Accounting Media with Ian Obaka.
So what is accounting? Accounting is often called the language of business. It is the process of recording, classifying, summarizing and interpreting financial transactions to provide useful information for decision making. But here is something you need to know. Accounting doesn't operate in a vacuum. It's guided by a set of fundamental concepts and principles that ensures consistency, accuracy, and reliability. These are what we focus on. Stick around. Accounting concepts. Let's start with the key accounting concepts that form the foundation of this field. There are a number of concepts, so we'll be taking them one after the other. Join us. So we talk about the business entity concept. This concept treats a business as separate from its owners. This means a company's financial records are maintained independently of the personal finances. For instance, if you are running a small bakery, the money you spend on groceries for your home shouldn't be mixed with the bakery's expenses. This is why you should separate your personal bank account from your business account. So let's talk about the second concept, money measurement concept. Here, only transactions that can be quantified in monetary terms are recorded in accounting. Non-monetary factors such as employee satisfaction or brand reputation, while important, aren't captured in financial statements. Number 3 is going concern concept. This assumes the business will continue to operate indefinitely unless there is a clear evidence otherwise. This concept affects how assets and liabilities are valued in the books. Let's talk of cost concepts. Assets are recorded at their purchase price and not their current market value. For example, if you bought equipment for $5,000, it stays on the books at $5,000 even if the market value changes. So let's talk of accrual concept. Revenues and expenditures are recorded when they are earned or incurred, not when money is received or paid. This concept ensures that financial statements provides a true and fair view of the company's financial position. Let's talk about the dual aspect concept. This is the foundation of double entry bookkeeping. This concept explains that transactions should have double entry recognition, that every debit entry must have a corresponding credit entry. But hey, this throws our minds back to elementary accounting that states that we should debit the receiver and credit the giver. Now let's discuss the core accounting principles. These principles ensures that financial statements are consistent and comparable across businesses. There are a number of these principles, so we'll be taking them one after the other. So sit around, let's dive in. So number 1, we'll be talking about the consistency principle. It says that once a method is adopted, it should be used consistently from one accounting period to another. This allows for meaningful comparisons. For example, if you are using straight line depreciation, which is a method of depreciation, don't switch to another method without a good reason. Number 2 is prudence principle. Accountants should exercise caution and avoid overestimating income or underestimating expenses. This principle ensures that financial statements are conservative and realistic. Let's talk of matching principle. Expenses should be recorded in the same period as the revenue they help generate. If you sell a product in January, but you pay the supplier in February, the cost of the goods is recorded in January. Number 4 is materiality principle. Significant items that could influence decisions should be disclosed. For example, a $1,000 discrepancy might be material for a small business, but negligible for a multinational corporation. Something is material when it's capable of influencing the decisions of users of financial statements. A loan of $50 is material when it could lead to a loss in the business for that period of time, which could have not been the case assuming there was no loan. Now let's talk of full disclosure principle. Financial statements should provide all the necessary information to users to make informed decisions. This includes notes to accounts explaining policies and unusual transactions. Let's talk of objectivity principle. Accounting information should be free from bias and supported by verifiable evidence. For example, sales should be recorded based on invoices and receipts, not mere verbal agreements. Let's talk of the real-life example of accounting concepts. Let's tie these accounting concepts together with a simple example. Here, I will tell you what these concepts require from this simple example. Imagine you are running a coffee shop. You purchase a coffee machine for $2,000. Number 1, under cost concept, you record the machine at $2,000, not its market value. Number 2, under accrual concept, if you sell coffee worth $500 in credit, you record the same immediately, not when the cash is received. Number 3, under matching concept, the cost of the coffee beans used for those sales is recorded in the same period. Right, so let's move. So next we'll be talking about why these concepts and principles matter. They ensure, number 1, consistency, that financial statements are prepared uniformly. 2, comparability. They ensure that stakeholders can compare performance across time and industries. 3, transparency. Users can trust the financial information provided, whether you are analyzing financial reports or preparing them. This concept provides a common ground for understanding and decision making. And that wraps up our overview of accounting concepts and principles. Remember, mastering these basics is essential for anyone involved in business or finance. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insightful content. Thanks for watching, and I will see you in the next video.